Hello, everyone. I am Guilherme Lapo. I am a partner of Experts Consultoria and Educação here from Brazil. And we are glad to have the opportunity to share some thoughts about multifamily real estate developments in Brazil. This is our presentation, Rental Housing Market in Brazil, a brief overview and unit economics. Thank you for your time, and we hope that the content of this brief panel will raise good discussion points, so feel free to comment below or email us. Okay, let's go. Okay, so we are starting our presentation here, and we all agree that many countries around the world and in Latin America as well have an important challenge facing the housing shortage. Brazil is one of them, and we would like to start addressing this issue here. So, according to the Brazilian Association of Real Estate Developers, Abrainc, there is a huge unmet demand for housing in Brazil, with approximately 8 million units missing. This is equivalent to 10% of all households in our country. In comparison, 8 million units is the total number of households in the Netherlands. And as another example, the state of California has approximately 13 million units. And more than 40% of, actually, more than 80% of the housing deficit is due either to family cohabitation or to rent costs that represent more than 30% of household income. And it is important to remember that 97% of this shortage in Brazil is among families with up to 5 minimum wages. The most populous region in the country, which is the southeast region, has the biggest shortage of units, with more than 3 million units missing. This is 40% of the total shortage of units in Brazil. And only in the São Paulo, in the region of São Paulo, a metropolitan area, there is a 900,000 unit shortage, with more than 50% only due to onerous rent. So we agree that it is a correct concern to address the housing shortage due to onerous rent. And maybe focusing on São Paulo's metro region, efforts could have a greater impact. Affordable rentals can be at least part of the solution, but that also comes with big challenges we will bring to the table today here. So, to address the shortage problem, we will have projects that must aim to rent apartments to low to mid-income families or individuals with household income from 4 to 6 minimum wages, or even a little bit more if you consider São Paulo's metropolitan region. Rent prices should be reasonable enough so that these families do not get included in the housing deficit again. So therefore, a potential investment project will have the following characteristics. A one-bedroom apartment with 25 to 35 square meters for individuals or couples without kids. We also know that nowadays the family profile sometimes includes pets instead of children. Or it can be a two-bedroom apartment with 40 to 50 square meters for families with one or two kids, like this floor plan we can see here in our presentation. These projects also have, like the apartments have one bathroom, one integrated living room and dining room, one kitchen plus a laundry tub, which is mandatory to get licensing here in Brazil. And this example of project here that also targeted low-income families in the state of Paraná, in the south region of Brazil, even included a small balcony with a grill. Projects focused on low to mid-income families usually have 6 to 10 units per floor, and in some cases, These projects can also take advantage of social interest zoning regulations that allow good construction potentials. This floor plan of a São Paulo city project indicates 9 apartments per floor licensed with two types of apartments, HIS, which would be social interest housing, and HMP, what would be a mid-income market housing. And these types of developments will also have different land site sizes in big capitals or in the countryside. Um, Due to scarce land availability in big cities, projects will probably be located in smaller land sites and thus have higher towers, which will probably have more than 15 stories high. On the other hand, in the countryside, we can find cheaper and bigger availability of land sites that can allow four-story buildings like the ones we see here with no elevator, and these would have lower construction costs. In many cases, we believe, in any case, we believe that developments should be well located in urban areas, close to amenities like education, transportation, healthcare, and the availability of jobs. Well, but any investor, even the ones with impact purpose, will consider the economic potential returns of real estate investments for rent. Thus, it is important to have in mind main trade-offs and cost of capital in Brazil. In the last decade, we have seen the risk-free investments given by the NTN-B 2035, this line in red here, which is the Brazilian Treasury bond with maturity into 2035. This yielded from 3% per annum to 7.5 per annum plus inflation. This is one, if not the most important trade-off for real estate investors for rent. Normally, commercial real estate investors pursue a risk spread over this rate. Another important data related to our subject is the historical rental yields of residential real estate. With this line here in gray, we can see the average rental yields in Brazil. With the line in black, we can see the average rental yield in São Paulo state, which was 20 to 70 bips higher than the Brazilian average in the last decade. These rates also somehow can be considered a real rate protected from inflation, given that historically the contracts have clauses regarding yearly adjustments. They ranged between 5 to 6.5% per annum on average. In several moments in the last decade, they were even lower than the Treasury bond, including nowadays. An important comment is that returns in this market are often even lower than the shown rates due to vacancy, its costs, and taxes. And why is that? We must have in mind that this market is largely unorganized, informal, and inefficient, dominated by independent landlords and high levels of bureaucracy. But we also highlight here that the low volatility of these yields are probably due to strong resilience of the housing market. We also brought here a fact about the Brazilian REITs that are called FIIs, Fundos de Investimento Imobiliário. Their dividend yields are currently around 5.5 to 8% per annum. These investment vehicles, managed by professionals, distribute dividends monthly, and they own finished properties rented to good tenants, and thus have reduced risk compared to new developments for rent. Fees dividends are free of taxes to individuals, share owners, and in many cases, these vehicles also don't incur in taxes on revenues nor profits. Considering the development and operational risks of an investment in residential real estate for rent, the efficient market would demand the correlated risk premiums for that. Thus, we believe that this type of project would demand economic results that would allow reasonable investment terms in line with the market. In terms of going in yield on cost or going in cap rate, if you prefer, what should be a good return that a developer would pursue? Here we indicate from 9 to 12% per annum plus inflation. That may be a good guess. And certainly, international players will consider trade-offs to invest in Brazil, like the US Treasury bonds plus country risk plus a deal risk spread. We hope to hear your opinion. Comment here below or email us if you want to talk more about this subject. So we also brought here to discuss the typical phases of a real estate residential development project, showing to you what are the projected cash flows of this type of project. This is an illustrative chart of a project's cash flow prepared by Rexperts Education. And let's point out to begin with that cap rates are not the internal rate of return of a project. Probably most of you watching this video know that already, but it's important to comment that as well. So that's why we want to quickly talk about the project phases, highlighting risks and costs involved. First, we need a very brave entrepreneur here in Brazil. If you are an entrepreneur, you have to face a lot of challenges. So that's why I'm starting pointing out that we need a brave entrepreneur. This entrepreneur will search for land sites and opportunities to do a deal. After finding an opportunity, initial investments in the deal assessments will take place. So probably we will have technical, environmental, legal, commercial, and economical feasibility and due diligence. All these costs are indicated here in an illustrative form. After feasibility studies and negotiations, this developer will have to buy the land site, pay notarial, legal, and other costs, eventually brokerage fees as well. Land negotiations are normally very complicated in Brazil because landlords usually expect values much higher than market. And to buy land, initial funding is normally already structured, either via equity or debt. Sometimes land can also be swapped for units or even financial participation, which adds some complexity to the deal. After having the property, the developer will face what can be the most challenging phase of a project in Brazil. Design and licensing, legal licensing, include not only the city hall, but also environmental agencies, historical heritage agencies, urban traffic management, among other activities. For that, normally a developer can expect at least 18 months or more to license a project until having the construction permits. Then comes the construction phase, which also adds other risks like keeping on schedule and on budget. Now we are facing high global inflation, and that worries real estate developers worldwide. Construction can also be financed by banks with available credit lines, by creditors with bond issuances, with the securitization of rental stream receivables, with bridge loans, or with the good and old equity. The good question is, how expensive can this capital be here in Brazil? We will discuss that later on. After construction conclusion and having all documentation needed, units may undergo interior renovations with investments in FF&E, furniture, fixture, and equipment. Then all this can take from 2 to 4 years, and pre-approved projects and pre-licensed projects can increase returns and reduce these terms. Then the lease managers will start offering units, and the rent revenue ramp up will finally take place. This is a resilient market with great demand that should have high occupancy rates and quick ramp up if rent is priced right. So we believe that to lease out an entire building, it can take from 1 to 2 years at the maximum if you price units right here, at least in the São Paulo market. But also, we must remember the negative cash flows like taxes paid, okay, depending on the investment vehicle, they can change. If we use the REIT structures here in Brazil, the PEs structures, we can avoid these taxes sometimes. But if we use a standard special purpose vehicle, then we would have taxes on that. These studies have to be done, okay? Also, all these vehicles will have expenses like accounting, auditing, and legal expenses. We have to take that into account as well. We have to pay for the lease managers and brokerage fees for brokers. We may have to pay amortization and interest on leverage, if applicable. And we also have to consider possible tenant defaults and collection costs. That could be a problem due to low credit score of some tenants. And their low income can also be deeply affected by any crisis. Other important observations in this slide is that some players have the private equity strategy, participating on the development phase, and they can reach high going-in cap rates, and they can exit this deal with compressed cap rates. And that sometimes, with additional leverage, can get returns above 15 to 20% per year, real IRRs. On the other hand, institutional investors can, or smaller REIT investors, can buy performed, full leased assets and expect to get reasonable real estate returns with rent, at least in line with the commercial properties fees markets here in Brazil. But until today, at least on the low to mid income segment of real estate development for residential here in Brazil, maybe due to high historical interest rates, companies develop units for low mid income families with the approach of building to sell, not building to own and rent. This format have extremely simple and well-tested products with less stock keeping units in the construction site that makes construction very efficient. Financially, the main difference is that once projects are approved and the sale of units start, the Federal Savings Bank, Caixa Econômica Federal, finances the acquisition of units to final users even before construction finishes. And the bank releases the resources for the developers proportionally to the construction schedule carried out. This way, cash from sales can be used directly in construction, and financing may be needed only for the initial construction cash exposure, like I show here, okay? And Caixa Econômica Federal, the Federal Savings Bank, can also fund the companies in this phase. And many companies use their equity also, given that the reduced amount of capital is needed for this type of project. Upon the delivery of units to final users, developers receive the remaining cash balance and project is finished here. This is a very industrialized, quick process, and the low capital exposure results in much higher IRRs. But we need to take into account that these companies Took a lot of time and money to develop all internal processes needed for that. They also have strong and professional competitors in efficient market, and their high overhead costs demand constant launches. So we ran our models for a real case study for a land site well located here in São Paulo city, and we will show you the results. Okay. For this case, we considered 10,000 square meters land site that could be acquired with all related costs at approximately 2,900 reais per square meters of land area. Development costs would demand additional 4,000 reais per square meters of leasable area. And this considers designs and licensing, also construction and FF&E, and we didn't consider any green building certification that could increase a lot these costs here shown in the chart. Okay, the total investment needed for this project would be around 150 million reais, or approximately $28 million, $30 million, more or less. This would be equivalent to 195,000 reais per unit, or 5,000 reais per square meters of leasable area. Could any players or construction companies develop properties for an even reduced cost? Maybe that's possible, and that's something that we could assess if we want to do a deal. But for now, that's a good estimate that we bring to the table here. Then rental revenues were based on the limit to address the housing shortage issue, which is we consider 2,700 reais per month per family as a total budget. That's about 35% of the income of a 6 minimum wage household. This is equivalent to 70 reais per square meters, and that includes not only rent but also all the furnished property tax, condo expenses, water, electricity, and internet. So that's not the price only for rent; it includes the whole package. Okay, this rent would be equivalent to something 10% below market today. So it would be a good rent to address the housing shortage issue. We considered management fees to be 10% of gross revenues here. Other operational costs were also considered, and for that we have a cash exposure of more or less 150 million reais, as I said. We are considered here for this case NOI margins of 73%. That is efficient. We believe that maybe this could be even better, and for sure we need to go into further detail for an executive business plan to be more bullish on that. And we also assumed that this deal is done through on a standard SPV vehicle with the correlated taxes. So with that, the net going in yield on cost calculated with NOI would be around 11.7, which would be the final cap rate in a REIT structure that would avoid taxes. But if we have the standard SPV, the funds from operation would end up with 9.7% per annum yield on cost for this project here. Okay, so here we are considering developing this property, renting out all the units, and we would have a terminal value. So returns for a player that develops to hold the asset for perpetuity with the standard SPV vehicle would range from 8.5% per annum to 10% per annum, with an average return in our base case here of 9.7, 9.3% per annum real rates. Okay, but if a player would take the private equity strategy, divesting this asset as soon as units are fully leased at a 7.5 to 8.5 exit cap rate, IRRs would increase to 16% and could reach 20% per annum. If leverage was available at an attractive rate, the developer would achieve even higher returns. On top of that, experienced developers could have lower construction costs and use less time for the development, thus having better returns. So, are these conditions good enough? Would the participants of the workshop be interested in a deal like that? Or what else would they expect? Do we have room for additional costs in green building certification? What if buyers demand higher exit cap rates here? So these are some questions. So how can we go on with this idea? Now what? So what if investors, family offices, and banks help fund proper housing with reasonable rental costs in order to address the problem? To summarize, we believe that the assessment approach by any investor in multifamily real estate should include three possibilities. The first one would be being an equity partner with the developers during the development until divestment, as in a private equity club deal project. But will your company consider participating with equity? Are there many developers focused on building to own? Would these players always divest the portfolio to REITs, or would they keep the funds from operations generated by the properties? Wow. The second possibility here would be to be a creditor that structures flexible bonds or does the securitization of the rental streams, similar to a mortgage-backed security, but with rental receivables. Will your company consider participating with that? What would be financial economic terms of bonds issued? Which developers would consider this leverage? In which conditions? Does the financial equation match the expectations? Would there be other metrics involved other than economic returns? And finally, um, investors could even remain as share owners or could anchor the REIT initial public offerings. Which cap rates would be interesting for institutional investors to anchor the fees IPOs? Would the limited rent price affect market interest? How big could this residential market get? Um, to, to sum up, where we have like a final comment here that there is a company here in Brazil from the MRV and Co group, which is called Lugo, and they closed a partnership with Brookfield to develop more than 5,000 units in Brazil until 2025. The company will build to sell to the institutional investor and then manage the portfolio for them. Um, how could investors and banks or family offices participate in a similar deal with these and other companies? So please write to us your comments. Thank you for your time. And if you want to know more about this subject or investments in the Brazilian real estate, don't hesitate. Get in touch with us at our email, contato@hexperts.com.br, and that you can find also easily in our website, www.hexperts.com.br. Okay? See you.